Podcast listeners. We're live on YouTube, LinkedIn, Facebook, Twitter, and in person. Let's get the show rolling here. Hello, Smart Money Tree Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with my good friend Doug Hagren. Hey, Doug.
Good morning, Kirk. Hey, I just want to tell you, you've gained a new podcast listener over the last week. My son was asking about it, and I realized that I did not have this podcast locked in on Spotify. So we searched it, we added it, and now my 10-year-old son wants to listen to this podcast when we're in the car versus any other music. So just so you know, you're starting to reach him younger. So in the next 20 years, you're gonna have a massive following.
It's my charming personality, Doug.
It's got to be it.
My curmudgeon nature doesning appeal to everybody, but apparently does the youth.
but you know what? On the other hand, I just think that he thinks you're an amazing. You do an amazing job analyzing talent and bringing them on a show. So.
That too. He's a good judge of character.
Absolutely. Well, I don't know. That's debatable.
All right, well, let's get started here. It's let's see, we're getting back here. So it's funny. I just got this past weekend, yesterday, was down in Tennessee with my son, my oldest son, at a hockey tournament, which is always fun, and just amazing. First time going to Tennessee, down Nashville, and beautiful weather there. And coming back to this, as the person sitting next to the plane on the way back is like, I can't wait to get back to that beautiful New England weather. Like what? Like 50? It was like 80 down there. It was great. Anyway,
well, I got to beef for a second because this past weekend, Minneapolis canceled their marathon, citing that it was too hot. So they canceled it the last second. It was in the high 60s, low 70s to start around the race start time, whatever that would have been, like 6, 7 o'clock, with a 50% humidity. I'm like looking at this around the country going, they run marathons and do triathlons in areas where it's like 90 degrees with 100% humidity. But the last minute, again, the blood just obviously runs a little thicker here. They're like, oh, we don't want people dropping dead, on the 65-degree beautiful day. So we might as well just cancel it. I mean, I'm sure that it was probably, some people are saying there was a lack of emergency, crews and, medical staffing. But sometimes, man, the excuses just sound stupider than, or more stupid than the truth. Because, just come out and say that. But to say it's going to be too hot with 50% humidity, most of the country would pray to have that.
My dad always used to say growing up, he's like, your generation's soft. Your generation's getting soft. He used to say that all the time. And I'm Gen X, so we're latchkey kids. We're basically, bred to do it yourself because no one's around. Like, oh yeah, let yourself in the house, go cook yourself some dinner. We'll be home at some point. If you need to put yourself to bed, go do that too. Like, that was our generation. Not to say that we weren't as tough as like as the ones who grew up in the Great Depression, because those were tough times. We didn't have that. They weren't easy times, but they weren't that. But this generation, Doug, I'll tell you, this generation's getting soft. I mean, there are people who there are races that are Ironman triathlons. There are ultra marathons that happen in 90-degree weather. So, if those poor marathoners can't do it, then boo-hoo. And that's coming from a guy who's never run a marathon. So for all those of you who were kind of getting mad at that comment, I've never run one, but let's be honest, there are marathons that are definitely tougher conditions.
The Gen Xers running it all were complaining, especially when they'd already made plans, flown into town, gotten hotels, whatever they needed to do to run this, and to find 2 hours before the race, it's canceled. I don't know who's on the committee running it, but they just need to replace them all. And going back to what you just said, listen, Gen X is the generation where we were 30 at 6 and we're still 30 at 50. So.
Well, let's dive. Enough of the chin wagging, Doug. Let's dive into some of the fun stuff. I was away, so didn't have as much time to prep for this, but there's a ton of cool charts here. I just want to run through a few and let Doug run through a few. Let's open up the screen here. Let's see. All right. So let's see. The first one here. There we go. So the first one here, just wanted to share this one because I thought it was interesting. So as of yesterday, today's the second, lost track of time when you're on the plane and traveling, but as of today's the second, as of yesterday, the interest payments started back up for student loans. And there's a big celebration in the streets with absolutely no one, because all these kids who went to college now have to actually start repaying their loans again. And obviously the student loans didn't get forgiven, but for everyone else who has to pay, you're back paying again. Which means, we're not crying over spilt milk over here, right? Everyone's got their loans, they got a reprieve for a little while. It's great, everyone's happy, but the reality is, you borrowed money, you got to pay it back. And now the problem isn't that you have to pay it back or start paying. The problem is that that money is now getting taken away from other things. So now when we have interest payments, right now it says personal interest payments shot up from like the pretty much from COVID up until I think it was right around 250 billion. Now it's up to around 500 billion, so it's doubled. And if you look at the chart, if you go to if you go to the video or you go to the website, you'll be able to see the chart. It's just skyrocketed in the last few years. Now, a lot of that has to do with the fact that the Fed printed a lot of money. And I would imagine right now what's going to happen, because people have a limited amount of money, that they're going to be pulling back on other things. They're going to be pulling back on luxury items. They're going to be pulling back on discretionaries, things that, maybe I don't need to go out for that dinner out. Maybe I don't need to get food delivered. Maybe I can go pick it up myself. All of these things that people have when you're middle class, upper class, that you can do things that when you're really tight in your belt, you can't. And so I just want to impress upon you that is going to affect the entire economy. Now, I don't know what the effect's going to be. And people have been hypothesizing this for a while, and it's really hard to say. You could speculate, but when you have times like this, when belts are getting tighter, things are tougher, the lower class always has it tough, because when inflation hits, they get hit first. And so if government support payments don't increase to help that's going to cause things like a lot more crime and other things, because people just can't survive. But now you're going to have the middle class getting increasingly affected by these events, because the middle class gets squeezed, and that's a much bigger percentage of the population. And now, granted, the middle class has been getting squeezed for the last 20 years, but it's still a relatively large segment of the society. So these people are going to start spending less because they just don't have as much to spend. Because if you think about it, like, what is, I have to say this, somebody put this in a tweet, and I wish I had it in front of me. Basically, what they said was, food, gas, and housing are not included in inflation. And what are the three things that poor people need? It's like, yes, let's just forget about the poor, because they don't need food, gas, or housing. Inflation doesn't affect them. Let's just ignore that. Let's look at it without those minor incidents. Now, as an economist, I get that. I have a degree in economics, so I just have to say, for all the economists out there who are just saying, you don't know what you're talking about, the reality is the reason they do that is because they're more volatile. And I'm not justifying it. I'm just telling you why they do it, right? So the reason why is food, housing, and energy, they're more volatile. You look at the energy price. We got down to like the 60s on oil, and now it's up close to 100. It's much more volatile, right? It's not necessarily tied to inflation either. Because if you look back, in the last, whatever it is, 60, 70 years, oil prices, even when inflation was high, you couldn't necessarily tack it to inflation, right? It was just oil prices were high because, what was going on in the 70s with oil prices and our kind of spat with the Saudis. So there are a lot of things that have happened that aren't necessarily inflation related. You could call it inflation because when you're paying more for gas, that affects everything else. But the point being is those three elements affect everybody. And yet those are discounted when it comes to inflation. So just keep that in mind, right? For all of those who've been complaining that, well, my food in the grocery store is going up 30% and inflation's only 8%. That's why. It's because it's not that they're not counted. They're discounted they shouldn't be, right? It should be, hey, this is like half of my budget or 2/3 of my budget. And they only count it as like 10%. I don't know the numbers. Actually, it's not 10% because housing is like 41%. But let's ignore that for a second, because that's actually not as accurate as you would like. Anyway, go ahead, Doug.
Yeah, I was going to add something. And by the way, it's interesting how you talked, in the beginning, that you kind of sounded a little Keynesian there. I don't know. Just be careful with your rhetoric. we're going to have to step up and help them if, give them, anyway. And listen, from an economist standpoint, people like to tout one economic theory versus another. All economic theory is based at some point on ultimately, there are times when certain things work and times when other things don't work. But anyway, that being aside, I just looked. Guess what? One of the best performing assets of the entire year is. This just got posted.
Bitcoin.
Nope. That was
true,
the one.
But it might be another one.
Yeah, tied to what you were just talking about. Oil is definitely up there. Oil's high, but that's not on. That's not the what I was coming up on this list.
Don't keep us in suspense, Doug. Tell us.
Orange juice.
Orange
juice is one of the best performing assets. Since its low in 2020, it's up 270%. This year alone, orange juice prices are up 70%, and live cattle and oil prices are at all-time highs. So, when you're talking about, when food prices are outperforming hedge funds, that's kind of, Kobesi letter just put this out. This is absolutely going to what you're talking about. And they don't include it, which of course, there's the other side. It's not the cause, but it's certainly interesting that when the government, has to tout inflation, and of course, inflation then ties loosely to what they decide with interest rate policy. When you put those things together, it's certainly, those items are very volatile. It also, because by excluding those, as you just said, food prices are much, much higher than that overall inflation number. That helps because remember, the government is also giving cost of living adjustments on things like Social Security tied to inflation. So it certainly doesn't hurt them to have the inflation number more tempered than what people are feeling. But as we've said many, many times in our conversations, unfortunately, the things that people need or perceive they need, like college tuition costs, food, housing, unfortunately, are the things that are taking the overall inflation number up to what, and they are the things that most families are going to unfortunately not be able to live without, and it's going to squeeze. And the other thing, going back to the chart that I wanted to say really quickly here, is I'm not sure when that Fred chart was posted, but if you can look at the rise of those interest payments, that started prior to this year and have shot up, which means it is highly likely that chart isn't even taking into consideration yet the restart of interest payments on or just overall amortized payments on student loans. So if you wanted to be, predict, and again, we don't make predictions here because unfortunately, predictions can go the other way, but it seems to be very likely that the trend is going to be that chart right now is actually a conservative view of what interest payments on households is going to look like here over the next months to coming years. And that right there is a scary thought.
Yeah, I'm going to touch on a few things here, and I actually want to touch on some things about this episode title as well, because I know some people yell at us and say, your episode title isn't always accurate. Well, I will say that intentionally it is, but it doesn't always go that way because Doug and I go off on rants. So I do want to share this one chart going off on my last point. So the U.S. Strategic Petroleum Reserves is something that we don't talk a lot about in this show, but it's been in the back of my mind for a while. And these two red circles, I didn't create these, but these two red circles are effectively the Biden circles. So the top red circle is when Biden started selling off the Strategic Petroleum Reserves, which is right around the time he started kicking sand in the face of the Saudis. So, go figure. Let's go start a war in Ukraine. Let's piss off pretty much everyone in the world. And by the way, let's sell off our Strategic Petroleum Reserves so that when we really need them, we have nothing left. Now, the funny thing about this is this amounts to a whole lot of nothing. Like the actual result of the Strategic Petroleum Reserves is negligible. It would barely keep the government running. Nonetheless, the military or anything else is needed. So I want to point that out. Like, this is something that was built up a long time ago for the purpose of, in an emergency, we have this. Well, apparently we don't have it in an emergency because they're selling it off. But the reality is, if you really want to have the argument, there's not enough to really run all that much because a lot has grown and the reserves have not. But this is more. This is kind of more of a window dressing kind of a concept. However, I do want to point out that the government is very bad at economics and they're very bad at markets.
No
And
way.
now the individual congressmen are very good at it. There's not a person in the world who can go from penniless up to a $300 million net worth without being in Congress. I mean, shouldn't say that. Not all of them have gotten that, but when you're a
Feinstein, excuse me, sorry.
Builds that kind of net worth doing nothing but being in Congress, that's got to say something, because I don't have that kind of net worth and I actually do productive stuff for a living. I don't just sit around and pontificate. But I don't want to pour out any beer for Feinstein. I don't. There was a funny meme that said, even though Feinstein's, despite Feinstein's death, it will not hurt her reelection campaign. So
yes,
I thought that was hilarious. Anyway, so I do want to point out, though, getting back to my point, is that the government is very bad. They will buy oil at like $90, $100, and they will sell it when it's at like $50, $60. Now Biden is talking about, now that oil is back up to 90, Biden is talking about buying it again. That's the opposite of what you should do if you were trying to manage a government's budget. But yet, hey, let's lose money. Didn't he say? And I hate to go on a political rant here, but it was just comical. He said something like he's actually gonna make money on oil. That when he said he was going to pull from the reserves, he said he was going to make money on oil. So far, that hasn't happened. So
he meant he's going to make money on oil, Kirk. You got to remember, it's between the fine lines. He will probably individually make money on oil.
Yes, we meaning he. All right. So I want to point out a few things, and I want to talk about what this means for the market, because that's really why we're here. So what we talked about in prior episodes is a lot of economic data. But here's something to note, right? The stock market has effectively declined over the last 2 months actually. It's the last 2 months we've had the market decline, which is not abnormal. For September and October are typically bad months historically, right? And August is a hit or miss, depends on the month. But basically, if you look at what's happened in the S&P 500, the S&P 500 for the year hit a high of somewhere right around 450, 460. Right now it's about 427. Okay. Now, so I think it was a high at like 16%. Now it's 12 or something like that. I don't know specifically. I don't have it in front of me, but something like that. Anyway, what I do want to point out is something that I, after the last episode, I realized and didn't have a chance to talk about it. And then the chief investment strategist over at Schwab, I forget her name, Saunders, Lizanne Saunders. She pointed this out, so I got to give her a hat tip because she said it publicly before me. Anyway, the S&P 500 is largely weighted towards big cap tech stocks. So if you take the S&P 500, it is market cap weighted, meaning the largest companies get a higher weighting in the index than smaller companies. So if you're the smallest company in the S&P 500, you get almost no recognition in terms of performance. If you're Apple, which is the largest stock in the S&P 500, you get the largest weighting, meaning that if Apple goes up like 50%, the S&P 500 is going to soar because it is a larger weighting than the smaller one. Now, if you take a more, let's say, a different approach, and you look at the RSP, which is an ETF, which is the equal weighted. I'm only using this for tracking purposes. I'm not saying you should buy this. RSP is an ETF which has a equal weighted S&P 500, which means every single stock has 1/500th of the performance, right? So it's no longer weighted towards the biggest stocks. It is even for all stocks. Now, if you look at this index, and I only use this for reference, I don't actually invest in this index. I don't trade it. I use it for reference. So I point this out because this is like a secret of the trade that everybody can take away from this. Look at the equal weighted indexes to see how the index is actually doing. You want to see how the market's doing? Everybody talks about the S&P 500 being the market. Okay, it's not necessarily the market, but it's one everyone points to. So it's kind of a reference point. If you really want, you want like the all stock index. And anyway, I'm not going to get into that. Vanguard does some of those. If you look at the equal weighted S&P 500, it's actually negative performance for the year. That's right. The S&P 500 has a negative performance for the year so far. Now, if you look at it, your index, and you're like, wow, I'm indexing, I'm up so much. And yet if you take out the weighting, the market cap weighting, it's actually down. Now, what does that mean? Okay, well, it means that you shouldn't invest in it because the S&P 500 is doing better. Okay, that's one approach. Well, if big tech doesn't do well, it's probably going to do worse. But if you actually look at it in the last few years, it's actually gone sideways. Starting right around 2021, in the first quarter, 2021, it's pretty much gone. I mean, it's gone up and down, but it's basically gone sideways for that period. It's down a little bit. Now, that was the same period that we talked about that the COVID cycle peaked. That's where all the money went into the financial system and it flattened out. Now, it kind of went up and down depending on which point you're talking about, but it was basically flat. If you look at for the last 2 years, well, actually almost 3 years now, 2.5 years, the market's gone sideways. This is the equal weight, which means that the economy has not grown. If you look at the stock market as the economy, which is not, but I'm just saying as an indicator, it really hasn't grown in value, which is really interesting. And you should say, like we talked about in the show, isn't that interesting? This is one of those points where you should say that, isn't that interesting? So for all of those of you who think that we're going on a tremendous new bull market right now, you could be right. But probability wise, it's not in your favor. Now, I'm not saying it's going to crash, because this is not indicating it's going to crash. It's indicating that it's going into the muddle through market, which we talked about a few years ago in this show. We are in a muddle through market. We're in this sideways, trudging in deep snow kind of market. We're not really getting too far. At some point, the markets may crash, they may spike, who knows? But right now, it's looking like the markets aren't doing all that great. So I don't know, Doug. What are your thoughts on this? I mean, this is really important. And I'm sorry, one more point before I kick it over to Doug. And I'm sharing a chart that has nothing to do with it, by the way. But if you look at the markets right now, October is typically also one of those months where you're just like, I might want to be out of the market in October. Historically, right? Some of the biggest crashes in October. It's not always great for performance. Although October could just start to skyrocket. It could. Who knows? But if you look at the technical analysts on the show, or the people who are interested in that, it's actually at a point where we could have an interesting inflection over anywhere from today up until the next few weeks, where the market could just start to go up. We could hit a point, and then the markets rebound and take off for the Santa Claus rally, as is sometimes called, where the markets, and also we're in the third year of the presidential cycle, which also can be positive at this time of year. So statistically speaking, the market should go higher from here, but it doesn't feel that way. And the markets aren't indicating that at the moment. So should you buy and go all in? No, you should look at and see what the price does. And if the price reflects that things are changing, then you can decide to invest. If it's not, then don't. At the moment, we're just sitting around just waiting. We're just waiting for something to happen. And if we start to see indications that things are getting better, or there's a crash, and we can take advantage of that. But for the moment, nothing is showing us that, hey, it's all sunshine and rainbows forever, and there's nothing bad, nothing to see here. So what are your thoughts, Doug?
Well, I think what you're talking about here is there's no clear trend, right? And there's no trend that says, hey, things are, like you said, things are looking great. There's no clear trend that says things are imminently ready to collapse. And Wall Street doesn't tend to like that. Now, we've definitely seen starting to see a reduction in profitability that has come out in some of the more recent numbers that have been announced. Something that for the longest time, as much as everybody used to, a lot of people, not everybody, but a lot of people, more bearish leaning individuals, used to kind of, try to say, all these things are going to happen. All these things are going to go wrong. The economy has got all these problems, but then profits would come in wildly, above expectations, or at least at expectations. I mean, for the longest time, it seemed like corporations could continue to do anything they wanted and squeeze juice out of it. And, again, we've explained a lot of reasons why that's happened. There's such an influx of money in the system that even though we could start to see the data on the bottom, at the bottom, begin to kind of unravel, all of that extra surplus money in the system at the top continue to keep that machine rolling. And at the bottom, we also started to see that, look, whether or not it's because they had more cash and were able to utilize that, or because they were using leverage, there was a continue I think, of trying to continue to maintain lifestyle at a level that people have become accustomed to. Now, what's going to go forward? Like you said, we can't predict. I think the reason you want to wait and see is we've got some, some really interesting data. There's another chart we can, I don't know if we've got it readily available, but actually right now, you're starting to see that while, the U.S. economy, consumers are continuing to throw money into treasuries. They're starting to, to push that up. You got hedge funds butting against that, significantly some of the biggest short positions that we've seen in history, which is of course creating some, there's word coming out. The regulators are starting to get a little bit concerned by this. We are starting to see the interest rates that are starting to, interest rates are starting to go up. As we know, as we talked, not starting to, interest rates went up, interest payments are starting to go up. We are starting to see a pullback. We're continuing to see higher interest of higher mortgage rates. We've now seen a higher spike in oil. And again, a thinking person's going to look at that and say, there's only so, again, households are businesses, but and all businesses, unless your name is the U.S. government, they've got a finite amount of money they get. They're either going to have to generate revenue and to keep up with their costs, or they're going to have to go out and get other people who are willing to give them money and continue to feed their ability to keep up with those costs. And that, of course, is, borrowing money from whatever sources, low interest rates, bonds that you issue, things like that. Those things are drying up. Okay. So as we have started to see now this access to capital, and I've said this repeatedly on numerous shows, the greatest cause of financial stress is lack of access to capital, whether it's in your personal household, but also inside the economy. Okay. Businesses, we're starting to see more and more of them are struggling to be able to keep up on their own debt and interest payments. And how have they gotten through this? Well, they've gotten through this by going out and finding more money to be able to get them through short-term cash flow needs. These things are starting to go. I heard, again, I don't have it right in front of me, another major lender in the automobile space is pulling out. Another major lender in the mortgage space is pulling out. Another major lender in the commercial office space and lending space is pulling out. One of the biggest players in commercial real estate for the longest time is a company called W.P. Carey. Excellent company, have done an incredible job, navigating through, a number of bull and bear economic cycles for real estate. They finally exited. They said they're selling off everything and getting out, which to me is an interesting sign, again, because they have never taken that position in the past, even when, you go back to the 2008, 2009 economies and things were unraveling. They still stayed the course, what they knew. They're getting away. So you're starting to see that this capital is getting tighter. Interest rates are getting tighter. Payments on interest rates are getting tighter. So yes, from a technical standpoint, what happens is, in a very, very simplistic way, you start to see that there are these trend lines, these support levels that that prices will get to, whether it's stocks, bonds, etc. And you'll oftentimes see a bounce off of that, or a move in another direction. Okay. And these trends, and that's what technical analysts love to look at, is whether it's, looking at 50-day moving averages, 200-day moving averages. There's lots of different technical things you get into. I'm not a technical trader, so I'm not going to try to make myself look foolish, or, like I work on the committee of a marathon trying to explain something that sounds more stupid than the truth. Okay. The reality is, though, they look for these things. Okay. But Kirk and I've talked about, there are times in which fundamentals come into play as well. Okay. And fundamental traders have had a lot of success trading fundamentals throughout history as well. So now you start to look at, the technical numbers might show we're starting to go into a possibility where there could be a downward trend. You look at certain technicals, say, all right, this might be a time we might see another bullish trend. But then if you go back to the fundamentals we're talking about, there is a lot of information out there that contradicts that. And as Kirk is saying, this is not a time to be able to, you can't look and say, oh, it's an obvious trend. Money's there. Things are flowing. I know some bad news has knocked it down, but you know what? Companies are still great, rolling in cash, access to capital, profits next quarter should still look good. No, it's not been this dire of economic information in a long time. Okay. So there's no trend line to say, look, I think clearly it's going to be rosy and bullish. But at the same time, and we've seen this before too, Kirk, and I think that chart we were showing about the hedge funds betting against treasuries, hedge funds started basically, the original hedge funds was just options trading, puts and calls. These days, hedge funds are speculators. And a lot of hedge funds through history have done very well until they went poof. There's been tremendous hedge fund bankruptcies out there. I don't know if that's going to happen, but what I'll tell you is that you're seeing a complete contradiction between where the hedge funds are betting and where the rest of the public is betting. And when that happens, there's going to be a give and take. There's no trend line there. And as long as there's no trend line there that says it's absolutely going to be imminently bearish either, patience is warranted, because we are at a time where things could break either way. And if you make the wrong bet, it could be catastrophic. The other thing that I wanted to the last thing I want to say, you looked at that chart and said it looked like it's been flat. I think this goes back to something, Kirk, you've said many, many times. The biggest risk that you can have, and I've talked about this too, the biggest risk that you can have in your investing is not necessarily missing a bull run, and it's not necessarily being exposed in a crash. The biggest risk that you can face is time, losing tremendous time in your wealth. If you're averaging, and again, this is a great conversation we can have for another day, but you can go back, and this is one of the biggest half-truths, is looking at average. Well, this average return is 10%. 10% average return. Well, you got to look at actual return as well. And if you look at actual return over time, average return can be completely contradictory to what actual return is. And at the end of the day, actual return is what matters. If you lose a decade, and we talk about the lost decade of 2000 to basically 2010 plus, that is time people never get back. And if it is in your critical working years or it's in critical drawdown years, unfortunately, the outcome for your wealth can be completely different than you've planned. So these are the times that can be most dangerous.
No, I totally agree, Doug. I think there's a lot of danger out there, and we're going to talk about where some of it is here, and I'm going to share some additional charts here. So, there's one big elephant in the room that people have stopped talking about. So back in March, we had a bunch of big banks fail, in large part because the liquidity was drying up, because interest rates were going up, and yet what happened was these banks had a lot of losses on their books. So, if you look back before they were raising rates, what was happening is these banks were buying like 30-year treasuries, which, it was the best rate they could get. And you figure, hey, rates haven't gone up in like 20 some odd years, more or less. So why not just hold on to 30-year treasuries, because you're going to get more money. And so what ended up happening is when rates started to go up, apparently nobody believed the Fed, which to me just boggles my mind, but nobody seemed to believe the Fed. And then all of a sudden they're like, wait a minute, we need to cash some of these out because people want their money back. And they're like, well, we have to take huge losses. Now, what's happened since these big banks have failed, it's kind of disappeared from the news. No one's talking about it. But yet, here we are, rates are still high, and these banks still have losses on their books. So here's a chart that just kind of shows the unrealized gain loss in the bank's equity capital. I'm not going to get to explain it too much other than the high level. Basically, what it means is the banks basically run on a spread, right? They borrow short and lend long, right? So what they do is they take your cash and then they lend it out to somebody else. Right. And they lend it out at they give you, let's say 2% on your cash and lend it out at 4%. Right. And so they make the spread of 2%. That's typically how banks work. Now they do other things too, but that's historically what they've done. Now, the problem is if they lend long and now the short end goes up, which is what's happened. Now the banks kind of get squeezed. So if you look at, and I'm going to share this really quick because I think it's interesting that I've pulled up, sorry here, let's see, do this again, do this on the spot. Okay, so here's a chart I just wanted to show. This is the U.S. Treasury yield curve, and I just kind of put this together when Doug was talking. So this is over the last year, and these different colors are different dates. So if you look at the last year, pretty much just, January 1st, it's this dark green line. Okay, that is a relatively flat but lower rate curve. If you look at it now, it's the blue and the red. That is a little bit more where we are. So what's happening, if you notice, the higher end, the longer end of the maturity of the yield curve, which means the bonds that are due like 7, 10, 20, 30 years, that is actually going up now. And so if you look at the short end of the curve, that is something the Federal Reserve has the power to manipulate because it's tied to the Fed funds rate. They say we're raising the Fed funds rate, all of the rest of the yields go up in unison. That's typically how it works. So they control the short end of the curve. They don't control the long end of the curve. They can manipulate it, by buying or selling long-term treasuries, but effectively they don't control that. That is what the market controls. Now, what Doug was talking about, I wasn't even sharing that chart. Sorry, Doug. Come on, Doug, you get on the ball. You wasn't sharing that. Anyway, I'll share this chart in the notes. But if you look at what's going on out in the markets, okay, there, as Doug had mentioned, the hedge funds are shorting the long end of the curve, which basically means as rates go up on the long end of the curve, they make money. On the other hand, you have a bunch of asset managers that are buying the long end of the curve. And they're saying, well, rates are as high as they're going to go, so we're going to lock in the high rates. Now, here's how bonds work. And I'm going to give you a quick primer on this because it's really important to understand if you want to understand what's going on here. Now, here's a quick chart. I got to go back to this. This is quick on the fly. There we go. Okay. So here's a price chart of the 10-year Treasury. And this is pretty much September. So it went from just above 4 up to 4.55%. Huge spike in the 10-year. That is enormous. I mean, that does not typically go that fast. So you should just be aware that that's an enormous spike. Now, what's basically happening is if you're buying, what I've been talking about in the show is buy the short end of the curve, right? Short end of the curve is where you're making your most yield. You can put together a ladder, just whatever, 1 year, 2 year ladder. You do it every 3 months and just buy it and you're getting 5%, 5.5%, depending on how you put it together. Okay, somewhere in that range. That's a great way to ladder it out. You're getting 5.5% on U.S. Treasuries. Okay, very low risk, as low as risk as you could probably get in bonds, and you're getting that in. But if you go in the longer end of the curve, it's not quite that long, right? If you go out to 10 years, you might get 4.5% or 4%. Right now it says 4.5. If you go out 20 years, I don't know what it is. I have to pull up that chart again, but you're not getting as good of a yield. Now, historically, you're getting a better yield on the long end of the curve, but right now you're not, right? Which is why we don't want to look there. The other reason is if you buy a 10-year or 20-year or 30-year bond and rates keep going up, you're going to lose a lot of money. That's why you don't want to buy the long end of the curve. Now, I'm not sure where long end of the curve rates are going to go, but at the moment, they don't seem like they're going down. Now, a lot of asset managers say, hey, I'm still getting 4.5%. That's really good. So they're buying the 10-year, which might be okay if you think that rates have peaked and they're going to go down. Then actually you can make some good money buying the 10-year or the 20-year or what have you. Personally, I've always said this for the last few years. We're going to have higher rates for longer than anybody thinks. Now, if we don't have a crash or an economic recession or depression or whatever is going to happen, if we don't have that, rates aren't going down. There's no reason to drop them. If anything, they might even go up. So what's probably going to happen is if we see a recession, which everyone's talking about is going to happen next year, I think there's definitely, everyone's getting scared. Well, I mean everybody. I mean everyone. The government, Doug, we shared a note in the show earlier. The government, certainly hedge funds, some of the smartest money managers in the world, based on their track record, are saying, "Hey, we're in for a credit event." And I actually want to point this out because we're talking about bonds. There's been a lot of news out there for the last few weeks of an enormous credit event. Now, some of you might not know what that means. Okay. Now, I'm going to bring up a chart just to kind of illustrate a little bit about what that means if I can find it. Here we go. All right. So, a credit event is basically a massive default cycle. Okay. Now, what happens in a credit event is effectively, I'll give you an example. People have been worried about this for over 10 years. In 2020, the Federal Reserve actually was so aware of it that some of the things that they did were done to stave off that happening. And we talked about it in the show at the time, but basically, high yield bonds are primed for a huge flush. Effectively, default cycle. There are a lot of non-high yield bonds, so basically corporate bonds that are of higher credit rating. So basically, triple B and above. And I'm not going to go into explain all this in the show. I have in the past, but we just want to get to the point. So basically, if you have investment grade bonds, triple B and above, those are considered safer. High yield bonds are below triple B. Now, if you get into the high yield bond market, it's very small in comparison to the investment grade. Now, if all of a sudden you have a bunch of investment grades being flushed into high yield, well, there's not as much money there. It's like putting a fire hose through a thimble. It's just you just can't do it. So it causes a huge default. It causes actually a lot of problems in the financial markets because of that. A default cycle is when you have raising interest rates, and now these companies have to refinance their debt at a higher rate. Well, they can't afford it because they're already squeezing themselves so much prior to this. If you look at the last 10 years, a lot of companies that probably should have gone out of business didn't because they could basically borrow money at 0% and out for 10, 20, 30 years. And they could just say, hey, I'm basically getting free money, right? I mean, a lot of these big tech companies said, yeah, sure, we'll borrow money at 1% over 30 years. And then we'll take that money, we'll reinvest it, we'll make 30%. Why wouldn't you do that? That's just smart, that's smart CFO activity right there. Like it's just a good thing to do, right? It's if you're running a company, that's the kind of thing you want to do. Borrow money and use that money to borrow it at 1% and create 20, 30% returns on it, which whatever your company is getting. And that's great. But not all companies had that, right? Some companies are borrowing because they're just trying to keep the doors open. They're trying to keep people employed. They're trying to wait until a future date when things get better. And this is happening everywhere. So this chart is basically showing this is a default cycle. If you look at the spike in default rates, when that starts to happen, that's the sign that things aren't good. And we're going to start to see bad earnings. We're going to start to see more defaults. We're going to start to see negative earnings in some case. I mean, you're hearing it now, but the credit event is when a lot of these things come together at the same time. And usually, I would say it probably is going to involve a crash of some sorts in some market. Now, I don't know which market. I don't know where it starts. We saw this a little bit in the bank sector in March, but it could start with the banks. It might not. Could start with a fund. Back in I think it was 2017 when we had 3 high yield bond funds close 3 days in a row. So one day, the next day another one, next day another one. They all closed. They basically froze your assets because they could not liquidate. Assets are worth 100, and then they just crashed, and now they're worth 10 cents. Well, they weren't going to sell them at 10 cents. That would be stupid. So they froze the fund and liquidated over the next 6 months, and then everything was fine. But the point is you're going to have a lot of weird stuff like that happening because the markets are not really geared to these type of credit events. Like they're very unbalanced. So when these things happen, you're going to see a lot of mess. We'll just put that in air quotes. We're going to see a mess in the markets. So this is why you want to have liquidity for stuff like this. In 2020, during COVID, I think it was early April, mid-April, when you had a bunch of these things. You had a bunch of mortgage REITs. Basically, you had one big mortgage REIT fund liquidate its entire portfolio in a day, and it just crashed the mortgage REIT market, which was great if you were buying mortgage REITs at that time. You could have made like 100% in a matter of 2 weeks because it wasn't the asset, it was the fund. And that is the structural problem, the type of structural problems that you're going to see in the next few years when these events happen. So when we see an event, more likely than not, there'll be structural problems, and people will focus on the asset, but in large part it'll be structural, meaning the financial system is not geared towards these events. So that's when you want to have the liquidity, is because of those events, because those events are going to be where you can make large returns in short periods of time if you're prepared and you know what you're doing. But you have to be on the ball, because that event in mid-April, that lasted a day, and then it spiked up, and it kept spiking up for the next like week or two. But the point is if you were there and you knew what was happening, you could have made lots of money. But if you're not ready, you would have missed it, right? It was very quick. So just be prepared and just be aware that these things are happening. And this doesn't mean it's going to happen tomorrow. You shouldn't jump out your first floor window or second floor. You should just stay calm and just be prepared and make sure you have liquidity. Make sure that in a time of crisis you can actually access your capital and you don't have to sell something at a discount to get it. So if you're an indexer, you might as well just turn this off because you're just going to be an indexer and the market's going to go up or down. And you're just going to go with it. But if you're anybody who's interested in opportunity when it comes, make sure you have enough liquid capital so that you can take advantage of that in the time. And frankly, even if you're an indexer, you should always still have cash on the side to take advantage of opportunities. But I understand the mentality is a little different for indexers, so I'm not going to try to convince you that the sky's blue. So anyway, Doug, what are some of your thoughts? Doug, you're muted. Can't hear you.
Yeah, sorry. I don't have anything added on to what you said there other than I think this comes back to, you've talked about the banks, right? What happened last time when the banks got stretched this thin? Government stepped up and created a second line of lending, right, in order to back those banks up. Now, that still exists, and the banks can still go to that if they become insolvent. But what you're seeing here is, like, what you're seeing here with that leverage, if I can borrow it for $100 and I can sell it to $300, which is effectively what they're doing with interest. If you just get from percentages to dollars, that's how they make their money. And a lot of these banks, we've talked about this before, locked into these long-term treasuries because at a time, 4 or 5% was great money compared to what was out there. But then all of a sudden, rapidly, the federal government changed this. And they jacked their interest rates up. So now these banks are sitting on 4 or 5% long-term bonds. And what's happening is they're paying nothing because that's how they make their money. They take 4% in, they pay 1% if you're lucky to you in the bank account. And the outflows are continuing, just increase left and right. So here's the thing. You make how much money on zero? Nothing. So every time these outflows disappear, it's twofold. It's not only the fact that they are sitting on these unrealized gains or losses, of money, the treasury that they can't unload. But every single time that a dollar moves from that bank's deposit to a money market or a brokerage account or some sort of short-term bond that's now paying 6%, that bank gets nothing on this. Okay. Now you start looking at the fact that they're locked into 2% mortgage rates, right? And so now they're not, again, that was something where they lent this money out for 30 years or 15 if you were foolish to get this low interest rate and then tell the bank you'll be happy to pay it off as quickly as possible, which is nuts, but that's a different conversation for a different day. But now these banks are stuck on this and they are literally locked in, okay? So now it's all fine and dandy until all of a sudden the bank is not making money because they don't have enough money that they can make deposits against in order to actually generate revenue. And they generate through fees and other types of lending products. It's all fine and dandy until all of a sudden people panic and say, I want all my money out. And the banks only have so much money, cash on hand, to do that. That's what happens. Go back, watch It's a Wonderful Life. This is what happens when all of a sudden too many people want their money out and banks only keep so much in the bank in reserves. And what happened is these regional banks, they should have collapsed. They should have collapsed six to 12 months ago. But they created another access to capital to let those banks live. Now, what you can see by the unrealized losses, you can see by the number of banks out there that are still extremely stretched. How long will they be able to have access to capital to replenish the reserves if there all of a sudden becomes a run-on to the banks? And I don't know. Again, we don't know when those run-ons are going to be. We don't know if those run-ons are going to be. But as we look at all the other data and look at all the people out there that are struggling for cash flow, you're going to see more people trying to get better yield on the money they have. You're also going to see more and more people just spending down the savings that they have. They don't have it, right? They've got to spend somewhere, which means they're going to turn to debt. And then the banks, in order to come up with liquidity, are going to turn to debt. Listen, Kirk, it's all fine and dandy as long as the faucet keeps dripping water. But as soon as that faucet goes dry, What are you going to do? And again, the federal government controls a lot of this. The U.S. Treasury controls a lot of this. And there are certain players out there that are extremely well positioned, which is also a scary premise if we're talking about monopolies and oligopolies. But there are some out there that are much more positioned than others. And again, if I could say one thing to kind of sum things up to you, don't be like the banks. Don't be like the individuals out there that are, the companies out there that are leveraged in debt. Clean up your balance sheet now. Make sure that you have liquidity access. Be your own bank. Lots of things written about that, but having enough money in your own savings account is being your own bank. If you need it, you go there. You get money from yourself. You don't rely on these external forces, because other people's money is available at a cost, but other people's money may not be available when you need it, especially if we continue to see the tightening on monetary supply.
Yeah, no, I appreciate that, Doug. So I want to touch on a few things before we kind of wrap it up here. And one of them is, along the lines of what we've been talking about. Let me see if I can pull it up. So what we were mentioning here before. So if you look at, this is what we were talking about before, the total assets, there's a ton of money being flushed into TLT, and that's the long-dated U.S. Treasury. Tons of money going in, and yet it's down 48% over the last, I don't know what depending on where you're looking at this, but basically it's down a lot. We'll just leave it at that. I didn't create the chart.
2 years or less for sure.
So. Yeah, it's down quite a bit. So the point being is, just because money's going in doesn't mean it's smart money. A lot of that's dumb money. And a lot of it's institutional money, by the way, which isn't necessarily dumb money because they have to put money somewhere. But it's just good to note that these type of things are happening. I also want to point out, here's another chart that I found over the weekend that I thought was interesting, which is effectively financial conditions are tightening. And what this shows is basically from, looks like July, August, financial conditions have tightened significantly. Now, does that mean it's a crash? No, absolutely not. It doesn't mean that. But it is something you should be thinking about. It's something that you should be aware of, that these things are happening, because, we're talking about in the credit markets or the debt markets, fixed income, it's all kind of the same depending on what you're talking about. I know people use a lot of words which can be confusing to people who aren't in Wall Street, but just understand that when conditions tighten, that usually leads up to some sort of crack in the system, because the system, when the Federal Reserve is printing money, it's printing money because it's creating liquidity. Liquidity is like, it's like the oil in an engine, right? The oil in your engine's not there because it needs oil. It's there to lubricate the parts so that things don't break. So you don't have metal rubbing against metal. Like it's lubrication. Printing money is lubrication for the financial system. Okay. So when the Fed is printing money, it's creating lubrication. So it's a lot harder to find a crash. Do they happen? Sure. But it's a lot harder to get a crash when there's plenty of liquidity, because the lubrication's there. So the engine isn't going to seize up. But when you have them, when they're taking liquidity out of the system, like they've been doing for the last year or so, that causes the market conditions to tighten. And it causes them to have less oil in the engine, which means there's a stronger likelihood of the engine seizing up. And so it's just important to understand that these things are happening. And I'm just pointing these out just so you can see it's not just us pontificating, but it's actually, there are real things that people are watching. Now, if you look at the big institutions, they're actually watching this, and they're very well aware of what's going on. So if you look at, I'm going to bring up another chart here, which I think was interesting too, before we wrap it up. So this is if you look at this chart, and this is probably going to be confusing, there's a lot of colors here. It looks like a bag of Skittles, but basically what this is, yellow is a 3 to 4% rate. Under 3 is light blue. Green is 4 to 5. Orange is 5 to 6, and 6+ is red. So what this is showing over the last 10 years is the percentage share of the mortgage market that is in certain types of mortgages, right? So if you look back at 2013, the highest share of the mortgage market is in 32% of the mortgage market was above 6%, which means that a third of the mortgage market was in 6% or more mortgage rates. Now, as of now, 38% is in 3 to 4% range, and sub 3% is like 23%. Now, I just show this because if you see how rates have dropped over the last 10 years, that obviously fewer and fewer people have that plus 6% rate. It's actually the lowest one. But a lot of people have 3 to 4% rate. Now, I point this out, A, because it's interesting, because it just shows how the mortgage market works. And when people say, oh, mortgages are going to crash, they're not going to crash. All people have to do is sit where they are. As long as they can pay their bills, nothing bad is going to happen to them. They have a monthly payment. The monthly payment is not going to change unless you have one of those ARMs or floating rate or something like that. But you have a fixed 30-year, there's no problem is going to hit you, right? Because as long as you can pay the monthly payment is not going to change. Now, that's all well and good for people that are existing and sitting in their home. But for people who need to buy a new home or to move, you're SOL. You're in that 6% plus. You're in 8% range, 7.5%, 8%, depending on where you are in the country. Paying 8%, that's really expensive. You're paying basically double the monthly payment of the 2.5%, and most people can't afford to pay double, Doug. So I think, we've been talking about this for a while, but people should know that even though we're talking about it, doesn't mean it's going to be a crash right away. For this very reason, that most of the market is in very low rate mortgages, and as long as they don't have to move, there's no problem here. Now, new homes, we pointed out a few weeks on the show. New homes are actually declining in price, while existing homes are not, because people are not selling and people are not buying existing homes. So the new home market, you can gauge that is a better indicator of the actual price, because the new home market, they need to sell them. They can't sit on these homes forever. So these builders need to sell, and need to sell quick. So the prices are going down for new homes. They're almost to the point where they're lower than existing homes, which is really weird. But anyway, that's actually an indicator to watch, because it's a lot more fluid, and you're going to see it may not be 100% accurate, but it's going to be more accurate than the existing home price. So
well, Doug, for the time being, Kirk, some of these builders are also doing self-financing. So in order to try to get people into those sales, they're coming in at 4, 5, 6% rates under the banks, and obviously with ready to go liquidity in order to push through those transactions. That's not going to be able to last forever. The one thing I do want to add on too is, like you said, these people are sitting in these homes, these existing homes, they don't have to move. We're already seeing in my neighborhood 2 or 3 homes that looks like they're getting prepared to go on sale in the next year. Why? Because the owners of these homes are in their 70s and 80s. This is a thing that I think people aren't talking enough about. It's like, well, people don't have to move. We have the number one control of homes are baby boomers. And guess what? They're getting older. So watch that.
Doug, where can people find more about you?
Get some information on the biggest cost that many of you, especially Gen Xers, like we were talking about at the beginning of the conversation. College is going to be one of those biggest, scariest things. It's never too early to begin planning. So if you're younger and you've got kids, it's a lot cheaper with a longer duration to be able to plan for college. Things are changing. Get creative. Know the numbers. But if you've got a child in high school here, it's going to be going to school in the next 4 to 5 years, you can't afford to wait. And you got to know the information so that you can even the game. Get that information now. Begin to educate yourself. Go to procollegeplanners.com. Learn what you need to know so that the surprise doesn't take you down.
Great. Thanks for coming on the show, Doug. And that's the show for this week. Thank you again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out our show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Also, we're now on YouTube. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. So please send him an email and express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.